Welcome back to Dividend Obsession. I recently started a series on my channel called Dividend Discussion that's going to allow other dividend investors to tell their story. One of the goals of this series is to allow each of us to grow through the experiences and lessons of others to make us all better dividend investors. Now, if you're watching this video, this is just a short clip from the full interview, so if you enjoy it, make sure you click on the link at the end of this video for the full interview.
Yeah, it's really the opportunity cost at the end of the day. If you put a dollar into this one versus a dollar versus that one, like over time, which one would have been better for you? That's the opportunity cost. And then also what you were saying about dripping, that's almost like using like a cup or a sponge to save a sinking ship. Like you're just like, okay, like I can add a little bit money to this and it'll stop it from sinking as fast. You're like, if I just scoop this water out and pour it over there, it'll, it won't go down as fast. But like at the end of the day, if you're losing capital year over year, hand over hand, fist over fist, whatever phrase you want to use, you putting the money back into a sinking ship isn't really gonna, stop it from going down in the long haul anyway.
Right.
So
So yeah, so lately my focus is more on looking for those stocks that have long-term history of growing their dividend consistently. In some cases, looking at the ones that maybe grow it every single quarter. There's like the ABRs, AMTs, CCLI, PAG, which is the Penske Auto Group, a few other ones that just very consistently grow their dividends and also have some capital appreciation coming too. And I've just been looking at things that tend to kind of outperform the market historically in the hopes, obviously past performance doesn't predict future performance, but if something's consistently, over the last 5, 10, 20 years, whatever, consistently been above, SPY or QQQ, then if you were to put together a portfolio of those things, then maybe you end up, getting a much better return on your money versus the things that have a consistent history of just going down the toilet.
yeah.
Your SDIVs or other things where it's just straight lying down.
Yeah, exactly. Yeah, you up into the rights where we're always trying to go for.
Yeah.
It's and the other thing that you mentioned about like past performance doesn't, indicate or guarantee future success. I hear that a lot because like I said, that's one of my three. I really have like three core and then maybe one or two, secondary pillars to my criteria. That is true. However, I could argue that I would rather invest in a company that has a reputation of showing that they know how to outperform the market and do it over a long period of time versus putting my eggs in the proverbial basket of a company that like, oh, they've promised in the next 10 years to beat the market, but they haven't shown any ability to do so in the past. So it's one of those.
Like I'd rather have a stock that goes straight up than one that goes
Yeah, exactly. Yeah. Or like even the ones I always pick on this stock, but like AT&T, like they've been like almost a straight line for like the last straight line or like slightly down ticking line for the last good while. They've always had a nice yield and all the things. And then they're like, oh, we're going to do this merger and this spinoff and this stock split and all kinds of stuff, anything they can do to jumpstart it. But at the end of the day, like, I mean, I get it if you're an income investor and like you end up needing the 7% or whatever yield that AT&T offers. But again, it's the opportunity cost of like you're only getting the 7% yield because you're either going to lose money in capital, at that point it's the capital depreciation, or you're going to end up being stable. So it's only the 7% versus if you have a company that goes up 10% in capital every year and also has a 3% yield. Then you're getting 13, and it doesn't really work like this, but then in theory, you're getting a 13% gain versus the only 7% from the yield because you're only looking at the surface level.
I really hope you all enjoyed that clip. Please make sure you guys leave a like on the video as it helps me grow my channel. And don't forget to subscribe for dividend related content and other interviews. If you're interested in being added to the interview list, send me an email at dividendobsession@gmail.com and I'll be in touch. Again, this was just a short clip of the full interview. If you're interested in the full interview, check that out right here. But until next time, see ya.